Did you know the richest families in America can live off millions of dollars every year and legally pay almost nothing in taxes? Sounds impossible, right? Well, it's not magic. It's a strategy called buy, borrow, die. And once you understand it, you'll see how the rich are playing a completely different game than the rest of us. Most of us are taught go to work, earn a paycheck, pay income tax, rinse and repeat. But the ultra wealthy don't think like that. They've figured out how to avoid triggering taxes while still enjoying all the cash they want. And the secret is in three simple words: buy, borrow, die. Sounds like the title of a bad action movie, but it's actually a wealth strategy. Let's start with buy. The wealthy don't just stash money in a savings account. They buy appreciating assets, stocks, real estate, and even businesses. Here's an example. Imagine you buy a house for $100,000 and in 10 years it's worth $500,000. That $400,000 growth isn't taxed as long as you don't sell it. It's what accountants call unrealized gains. The rich stack their portfolios with stocks, properties, and art. Anything that grows in value but doesn't force them to recognize taxable income. Now comes the fun part. Borrow. Instead of selling their stocks or real estate and paying tax on the gains, they go to the bank and say, "Hey, I've got $10 million in Tesla stock. Can you lend me $2 million against it?" The bank happily agrees because that stock is great collateral. The rich get millions in cash without selling and without paying capital gains tax. And here's the kicker. In the US, loans are not taxable. When comparing interest and taxes, here's why it's genius. If you sold $10 million worth of stock to live and your gains were taxed at 20%, you'd owe $2 million in taxes up front. But if you borrow $10 million against your stocks, you just pay loan interest instead. At 4% interest, that's $400,000 a year instead of $2 million in taxes gone forever. That's a $1.6 million savings in a single year. Even better, their investments keep growing in the background. If the portfolio earns 8%, which is $800,000 on $10 million, the growth more than covers the interest. It's like paying a small service fee to keep your money compounding while you enjoy the cash. Meanwhile, the rest of us are debating if we can stretch DoorDash leftovers for 2 meals. And here's where it gets kind of dark. The last step is die. When the wealthy pass away, the assets they own get something called a step-up basis. This means the value of the assets reset to the market price at the date of death. So if grandpa bought Apple stock at $10 a share and it's worth $200 today, his kids inherit it as if they bought it at $200. The $190 per share in gains just disappears for tax purposes. Translation: that entire lifetime of tax deferrals vanishes into thin air. The family avoids paying capital gains tax completely. The heirs can sell right away and owe nothing on decades of growth. So, buy assets, borrow against them, die and let your heirs inherit tax-free. Congratulations, you've just avoided taxes like a billionaire. Alright, let's bring this down to earth with an example that might hit closer to home. Say you're 30 years old and you want to live off $100,000 per year until you die. How much in assets would you realistically need to pull this off using buy, borrow, die? Here's a simple setup. You've got $2.5 million in stocks or real estate. You borrow just 4% against it each year to cover your living expenses. That's your $100,000. At the same time, if your portfolio grows at a modest 6 to 8% a year, it's adding about $150,000 to $200,000 annually in value. That's more than what you borrowed. So your lifestyle is funded, your portfolio is still growing, and you're not selling anything that triggers taxes. Now, fast forward at age 70, that $2.5 million portfolio could have ballooned to $20 plus million, all while you've lived comfortably on $100,000 a year. When you pass, your heirs inherit the full portfolio with a tax reset. That's the power of buy, borrow, die, even at middle wealth level if you plan right. It's not just a billionaire game. You don't need a yacht to use this strategy. Even a solid fishing boat will do. Now here's the question I know a lot of you are asking. Wait a minute, what happens to all the borrowed money when the person dies? Doesn't the bank want it back? The answer is yes. The loans don't just vanish. When someone passes away, their estate has to settle any debts before the heirs receive the assets. But here's where the strategy still works beautifully because of the way the numbers stack up. Let's say a 30-year-old starts with $2.5 million in assets and uses the buy, borrow, die strategy. Each year they borrow 4% on the portfolio, which is $100,000 to live on. The loan interest rate averages 4% over their lifetime. Their portfolio grows at 7% per year on average. By the time you're 85, here's what it looks like. Total borrowed over 55 years, about $5.5 million. Total interest paid, roughly $7 to $8 million over a lifetime. Portfolio growth, that original $2.5 million would have grown to over $60 million by age 85, even after borrowing. When they die, the bank says, okay, estate, you borrowed $5.5 million plus interest. Let's call it $12 million in total. The heirs inherit the $60 million portfolio, and then they can simply liquidate $12 million worth of assets to pay off the loans. Here's the kicker. Because of the step-up basis, those assets are treated as if they were purchased at today's value. So when the heirs sell $12 million to pay off the bank, there's zero capital gains tax. That means the heirs still walk away with nearly $48 million clean after all debts are settled. Amazing. Now, here's where the magic, or rather the math, really shows its power. Over 55 years, this person paid maybe $7 to $8 million in total loan interest. That sounds like a lot until you realize what they've saved and gained in return. If they had sold investments every year to live on $100,000, they would have paid roughly $15,000 to $20,000 in capital gains taxes annually and about $800,000 to $1 million over their lifetime. But that's not the total loss. By selling a little every year, they'd constantly shrink the portfolio that's doing the compounding. Instead of their $2.5 million snowballing, growing untouched into $60 million, they'd end up with closer to $20 to $25 million by age 85. So yes, the direct taxes being avoided might be about $1 million, but the real arbitrage is that the buy, borrow, die method lets the entire portfolio keep compounding untouched for decades. That's what creates the extra 20 to 30 million in final wealth. In other words, the borrow strategy costs you interest, maybe 4% a year, but keeps your money growing at 7%. The sell strategy, on the other hand, saves you interest payments, but cuts off your compounding. And compounding, my friends, always wins. That's the arbitrage. The growth of assets far outpaces the cost of the loans. It's like choosing between paying full price for your groceries every week or getting a permanent half-off coupon for life. Which one are you gonna pick? So yes, the loans get paid back when you die, but compared to the massive growth of the portfolio, it's just a drop in the bucket. The heirs use a slice of the inheritance to clear the debt, and thanks to the step up in basis, they owe no taxes on the sale. the remaining fortune is still massive and completely clean. And this is why the wealthy love buy, borrow, die. They avoid annual taxes. They enjoy their lifestyle funded by cheap debt. Their assets grow untouched for decades. And when they die, the slate gets wiped clean for their heirs. It's the ultimate tax loophole that everyday earners simply don't get to use on their W-2 paycheck income. So the next time you hear someone say the rich don't pay taxes, this is exactly what they mean. Buy, borrow, die. Simplified. How the rich pay $0 in tax. Now, do I recommend you go out and start borrowing against your Robinhood account? Probably not. This strategy is best suited for people with serious wealth and access to cheap credit. But now you know the rules of the game, and who knows, maybe one day you'll use them for yourself. Thanks for watching. Don't forget to like, share, and subscribe if you want more hidden financial strategies explained simply. And if you'd like to support the channel, you can buy me a coffee using the link in the description. This video is for educational purposes only and not financial advice. Always talk to a qualified financial advisor before making big money moves. This is your financial watchman, and I'm signing out. Bye bye, y'all.